Hello, this is Lance with Verivest, and today I have with me Mr. Mark Hanf with Pacific Private Money. How you doing, Mark?
Great, Lance.
Yes, thanks for your time. Appreciate it. So I'd like to kind of start out, maybe give us tell us your story about how you ended up getting into real estate and to the loan business. And I know you've been in business for a long time. So how did you what was your origin story? How did you get into this line of work?
Well, I was born into real estate. My dad was a developer. And so as I grew up as a teenager, I used to work for him every summer on his construction crews. And then after college, I graduated in 1982, and we were going through a little bit of a recession there. And he split up with his partner at the time. And coincidentally, I wasn't planning to go to work for him at the time, but he said, "Hey, why don't you come over and I need someone to run my accounting and do the background run the office for my company." And so I went to work for him, and there I was for a little over 20 years. And so really what I did in that capacity was I did most of the accounting. I raised capital. I handled all of the bank loans, a lot of the stuff that that he wasn't really an expert at. He was the rainmaker. I basically ran the office, and it was a great synergistic relationship. Learned a lot about real estate, both residential and commercial. We had a portfolio of properties, and we were doing development. And that company, like hundreds of family-owned, relatively small to mid-sized development companies, we did not survive what happened in the real estate market between 2007 and 2008. In fact, we were actually an early casualty because we were all in on some development projects, and the banks stopped lending and stopped making draws, and we had to fire sale stuff. My dad was at an age at that time, this is 2007, where he decided to retire. And I ended up going to work for a family friend who was also a developer who did hard money loans as a way to earn additional income. Now, he didn't know it, and I didn't know it when I went to work for him in 2007, that he was a year away from going out of business. So in 2008, I'm jobless and decided, hey, I think I could do something with this hard money loan origination business model. And so my wife and I started doing this out of our home office in the summer of 2008. We know what happened in October of 2008, but I had already had maybe a dozen loans under my belt by then. I kept persevering through 2008 and 2009 into 2010, and finally made a business out of it. Rented an office in 2010 in the Bay Area, hired my first employee in 2010, met you, Lance, at a hard money lender event in 2012, and then shortly thereafter, you guys helped us launch our first fund in 2013. And so now 13 years later from when I first got into this business, I have close to 20 people on my team, 12 full-time employees, a number of agents and associates. We just launched our fourth fund, as well as launched a non-QM lending division. So we're really all in the alternative lending space, primarily still hard money, private money, but we've really worked our way into a number of niches, including owner-occupied purchase money financing, ground-up construction financing, all through private capital. And it was really fortuitous that I got into this business, because I had no idea that Dodd-Frank was going to come around. And Dodd-Frank really opened the doors for the alternative lenders to thrive. And then in 2013, when the Jobs Act passed and they made it legal to raise capital on these Reg D funds, that was another boon to the industry. And here we are in 2020, and alternative lending is still among the fastest growing in the lending sector. So it's a fabulous business model, and I've got a great team, and we've been growing. We've been really we've been growing very quickly here in California.
Yeah, no, it's been great to be part of your guys' success for sure. So like for you with it's obviously gotten really competitive. So for you and your team, what is it? What's sort of that acquisition strategy, or how do you source your opportunities? Like, how do borrowers find out about you vis-a-vis some other loan program?
So I've always said that deal flow is the golden goose when it comes to being in this business, originating privately funded loans. There's plenty of people out there that have capital that like to fund loans or invest in mortgage pool funds. The challenge is really the deal flow. And so from early on, I've been a big believer in marketing and spending a lot of company capital reinvesting in the business. So we've been very prolific on email marketing. We've been very prolific on the radio, on print ads, and really developing our referral partner network with mortgage brokers, bankers, and realtors. So when you combine all of that, our goal has always been to be ubiquitous in the marketplace so that when people think, hey, I need a hard money loan or private money loan, if they don't think of us directly, they ask somebody, we end up with a referral. So we are blessed with a really large amount of weekly and monthly deal flow that comes in. So our emails come in every day, phone calls come in every day, leads come in off our website every day. And the reason it's important to have a lot of deal flow is you got to say no a lot in this business. Yeah. So we track our numbers and we're saying no about 9 out of 10 times, which allows us to really cherry pick the deals that we want to see and politely turn away the ones that are a little bit too hard money or just really aren't in our wheelhouse.
Yeah. So in terms of in the Northern California sort of market, are there certain areas or like key markets inside of that? Or do you feel like, do you view it differently as terms of like where you would originate loans or maybe share a little bit about the market?
We're all over California. California is obviously a big state, population of 40 million. There's a lot of deal flow in California. A lot of companies like ours have chosen to go outside of California, either do, Western states or even all 50 states, but we've really focused on the California marketplace for our direct lending and both Southern California, Northern California. We have agents in Southern California as well as all over Northern California. In terms of, being market conscious, I do a lot of studying, as do members of my team, and reading the various reports that come out from, industry professionals as to what's happening in certain markets. Like, for example, what we're going through right now with COVID, San Francisco, the city of, is seeing some interesting market conditions that aren't playing out elsewhere in California. For example, today prices are declining in San Francisco, but they're actually continuing to increase in the rest of California. So it's things like that. It's just having your ear to the ground and talking to our referral partners, our realtor referral partners, and taking the temperature of the market and just being aware.
Yeah. Do you feel like in California, with it being so densely populated and, it's like the third largest economy, in the world on its own or something like that. So how does that impact, that the competitive environment in terms of rates and those sorts of things, is that, how does that manifest itself? Or do you feel like that is the beauty of California, is that people want to be there and it's, it always creates that kind of liquidity, so to speak?
It is the most competitive market of all the states. We have the lowest priced private money lending here. What's interesting is we don't do as much fix and flip financing at Pacific Private Money as we do ground up, because fix and flip as a specific space has gotten very, very competitive, where rates of 8% and 1 point are not uncommon, which, based on our cost of capital, we've just elected not to play in that area. We think it's got a little bit too frothy. Mm-hmm. However, on ground up construction, that is an underserved market niche. Contractors are not getting funding from banks, and most of those fix and flip lenders, in fact, the biggest lenders in California, are not doing ground up construction. They're really focused on fix and flip and business purpose lending. We also focus not only on ground up construction, but we went to the consumer purchase money bridge loan because we saw an opportunity to help people acquire their next home with fast, easier to qualify for financing, so that they can at least capture property in a competitive market and then conventionally refinance out later. So it's kind of markets like that we've taken a look at is where's the market underserved, and we see it both in the consumer and the ground up construction as being the most underserved. And then everything else, that's probably about a half our volume, and the other half is just kind of everything else that's hard money. Again, because we're ubiquitous, we get a lot of phone calls, and we may not be the lowest price lender in the state. But again, with it's an inefficient market, so we don't get every deal. We lose some to competition, but we hold our pricing and we hold our underwriting guidelines. And with that, we're still on pace to do about $200 million in the next 12 months.
Wow. So as a good segue to that, then, I mean, in terms of your overarching kind of investment philosophy, what is that? How do you, like you say, you're turning down 9 out of 10 deals. So, what are sort of those guiding lights in terms of how you determine whether or not a deal's worth doing or a loan's worth originating?
So great question, because this is not your dad's hard money. This is not the same industry it was 20 years ago. Thanks to Dodd-Frank and the Jobs Act, we are now regulated, we're legitimate, we're licensed where we weren't before with the new NMLS licensing program. It is alternative lending. I even rarely use the term hard money anymore because hard money elicits a lot of emotional thoughts and reactions as to what the quality of the loan is. What's different about lending today in the private lending realm, in my opinion, is that we look for transactional distress, not borrower distress. Okay, what do I mean by that? Borrower distress is bankruptcy or 1 foot in bankruptcy, low FICO, very, very distressed, desperate for capital, and has real estate that he can finance. Maybe he's going to pull money out of his primary residence or property that he owns. We do very, very few of those loans. On the other hand, transactional distress is someone's in contract to close and their bank financing glitched last minute. And a lot of things are happening in today's conventional lending where it just takes longer and longer and longer, and they've got a hard deposit at risk, and they don't want to lose that, or they want to be competitive and make a cash-like offer. And you could do that with private financing. So really, we look for transactional distress, not borrower distress. Our average borrower has over a 720 FICO score. And it's not unusual for us to do a loan to borrowers with over 800 FICO scores. And I know a lot of people say, well, that's ridiculous. Why don't they just go to a bank? Well, if you've listened to what we're talking about here, the banks can't close financing aggressively. And if they want to close in 14 to 21 days, in many of the markets in California, they're still very competitive. You're not going to be able to do that with bank financing. So we act as a tool to capture property. Very rarely do they hold our loan for a year. They pay us back. All of our loans have no prepayment penalty. So we're really in the business of providing a financial tool for borrowers to be able to complete their real estate strategy, their real estate transaction, pay us back, and then we turn around and lend it all over again.
Yep, that makes sense. So how about like post origination? I know you guys service your own loans.
We do. I like servicing our own loans. I know there's good reasons why a lot of people choose not to, because there's these great third-party companies that can do it relatively cheaply. But especially now during COVID, what we've really appreciated having hands-on in-office servicing is that we can really reach out directly to our borrowers at any point. I mean, we're right on top of them. So we like that closeness to our borrower and the hands-on approach. So we've always done the internal servicing. It also allows us, when appropriate, to do workouts, and we've done some workouts. And again, when you're friendly and communicative with your borrower, and they're the same way back, there's a lot of things one can do, and especially if you've got investors that understand the long-term strategy of what we're trying to achieve here, and not be too concerned about a short-term stutter step.
Right. So in terms of like the rest, I mean, at this point, like you said, you've grown, your team's gotten bigger. So maybe give us a little bit of a thumbnail sketch of sort of the other key players on the team that kind of help execute the strategy at Pacific Private Money. So
a lot has happened to us in 2020. While a lot of companies were retrenching and really pulling back, we actually have grown in 2020. So my COO, Nam Phan, is a stakeholder in the company that owns all of the divisions of Pacific Private Money. We call it Pacific Private Money Group. I have 2 senior underwriters that both have 30 years experience in lending, both named Richard. So we've got, and then our compliance officer and head of our docket processing, is 15 years in private money and well regarded in the industry. We have a financial partner who invested in our company this year, who's a capital partner who has opened up a lot of opportunities for us to gain further access to capital that makes it easier for us to grow and enter new markets. And it's helped us to launch these new funds, these new investment opportunities, because for the better part of the last 7 years, we just had the one fund that investors could decide to invest in. And in the last, like I said, the last 6 months, we've now launched 3 more funds. Now we have four ways to invest, as we like to say here, with varying levels of risk and reward.
Yeah, no, that's great. Well, this is really good. Yeah, well, thanks so much for your time, Mark. I really appreciate it.
All right. Thanks, Lance.
All right, take care.